In this chapter, we're going to talk about financial statement analysis. So far, we've learned about all the financial statements. We've covered the income statement, statement of owner's equity or stockholders' equity, the balance sheet, and then finally the statement of cash flows. So this chapter is going to show us how to make those statements even more useful. And that is by performing financial statement analysis on it. So in this video, we're going to be talking about objective 1. Describe the techniques and tools used to analyze financial statement information. So besides looking at just net income or what the balance sheet is telling me, we can actually perform some computations on these and gain more insight into the business. So what we can do is we can compare a company in several different ways. The first way is to compare from year to year. So we could look at net income and compare it to last year to see if we made more this year compared to last year. That would be comparing year to year. Another way to compare is to compare from between two companies. How did Walmart do compared to Target? And then another way to compare is the industry as a whole. How did Walmart compare to all other companies in its industry? All right, the 3 ways that we're going to do this is, first, we have horizontal analysis. And horizontal analysis is going to be comparing year to year. And if you think about the financial statements and you remember the columns that we have, a company will put 2019's information, and then right beside it they'll have, let's say, 2018's information next to it. So if you look across, you can see 2018's information and compare it to 2019. So we're comparing across from year to year. So that's why it's called horizontal analysis, because we're comparing horizontally. The next method is the vertical analysis. And we know that vertical is up and down, so that means we're going to be comparing items inside the financial statements. An example would be if we compare total revenues to utilities expense. We're looking at items vertically in that financial statement, and that's going to be called the vertical analysis. And the final way to analyze financial statements is the common size statements. These are getting into your ratios, so we can analyze financial statements using a ratio analysis. And this is where you're going to have a numerator divided by a denominator. For all publicly traded companies, there are corporate annual reports that are available to the public. Smaller companies or companies that are not publicly traded may have these reports too. They just might not be available to the public. And an annual report is going to provide information about the company's financial condition. And you can go online right now and find a corporate report for any publicly traded company. Some companies that you could go look at, such as Walmart, Amazon, Google, Target, McDonald's, those are just a few where you could go online and access their annual reports. So you could pull these up and perform those ratio analysis on them. The ratios are usually published online, so you could actually look at those. So the annual report will include management's discussion and analysis, and it includes management's analysis of current operations and also its plans for the future. And this corporate report would have an independent opinion from an auditing company. And this auditing company is going to attest to the reliability of the financial statements. So here you can see that Sarbanes-Oxley requires this, and you will see that there will be 2 reports, one internal by management and then one by, like I mentioned earlier, the public accounting firm. So the requirement is for all publicly held corporations to have an independent audit of their financial statements. So the firm is a certified public accounting firm, and they will conduct the audit, as I mentioned earlier. And in that, they will give their opinion on the fairness of the financial statements. So they'll have an opinion stating that the financial statements they fairly represent the financial position of the company, and the results of the operation and cash flows of the company is said to be an unmodified opinion. This is called a clean opinion. Any report other than an unmodified opinion is going to raise red flags for financial statement users, and it will require further investigation if it is a report other than an unmodified or clean opinion. So back to the corporate annual reports for a second. So the financial statement will be in there, and any notes, management's discussion and analysis, a report on internal control, and then a report on the fairness of the financial statement. So if this is a publicly traded accounting firm, you can go online and look at all of this. If this is a publicly traded company, sorry. Alright, so now we're going to learn how to perform a horizontal analysis. So remember, a horizontal analysis is comparing from year to year. So what we're looking at here is the increase or decrease. So many decisions will hinge on this increase or decrease from year to year. So when you see a company's sales decrease, you may see this as an issue. So an example of a company that decreased, and Ms. Bergeron, the other accounting instructor, uses this as her example, and I thought it was a really good one. Blockbuster. Who remembers Blockbuster? And some of you may be too young to remember, but there was a time when we used VHSs, and then we moved on to DVDs, and now we've kind of moved on to streaming. But Blockbuster was a company that had a store that you could rent movies, mainly tapes. So I remember going into Blockbuster many a times and renting VHSs, and it was a big deal and it was exciting. But then they moved on to DVDs, but what they failed to do is to compete against companies like Netflix. So their inability to keep up with the changes to digital format caused them to not be able to compete with these companies such as Netflix and iTunes. And eventually they went out of business. So what you could see with horizontal analysis when looking at the company Blockbuster is that their sales from year to year declined. And the reason that the sales declined is because they could not keep up with technology. They could not keep up with the change. And if you would have looked at their expenses, you would have seen that their expenses did not decline fast enough, and they ended up having net losses. They still had expenses, they still had stores, they still had salaries to keep up with, and their sales were steadily going down. So if you would have performed a horizontal analysis and looked from year to year, you would have seen this decline in sales. So let's look and see how to calculate the numbers for horizontal analysis. Okay, so here we're looking at the cash and accounts receivable balances for a company. And so here is the current year, right here, and then here's the prior year, okay? So what they're wanting us to do is find the amount and percentage of increase or decrease that would be shown on the balance sheet with horizontal analysis. So keep in mind that your base year, okay, is right here. Okay, so what we're going to do is first you're going to calculate the change. You're going to take the later period amount and subtract the earlier period. So when you do that for cash, 62,500 minus 50,000, you see that you have 12,500 difference. All right, so I have written this formula up here to show you that that is how you get the dollar amount of change. Okay, now how do I know it was an increase? Because it went up from the early year to the current year. All right, now accounts receivable, if you look at it, the change, if you do the later period minus the earlier period, you get a negative. That's because accounts receivable decreased. So you have to keep in mind that the increase and decrease, you have to think about, did it go up or did it go down from the earlier year to now? Then, if you want to know the percentage, okay, I've written that down here. Once you get the dollar amount, you're going to divide that by the base amount. So for the cash, if you use your calculator, and I'll just pull it up. So let me move it over so y'all can see it. If you do 12,500 divided by the base year, which is the earliest year, you will see that 0.25, if you times that by 100 or move the decimal 2 places, that's 25%. That is a 25% increase in cash. For accounts receivable, the change is 5,600. Divide it by the base year, which is 80,000, and times it by 100 or move it 2 places to the right to change it to a decimal, and it's a 7% decrease. So that is how you perform a horizontal analysis. And you can see here the horizontal analysis, they have done this with the whole balance sheet. And just to go back for a second, remember you divide by the oldest year. Get the change, that's step 1 up here, okay? Step 2 is take the dollar amount divided by the oldest year. And step 3 is to times it by 100. So you could say cash from, let's say, 2020 to 2021, cash increased by 25%. So that would be what a horizontal analysis does. Okay, now let's say you increase by 25% from 2019 to 2020, and then from 2020 to 2021, you only increase by 10%. So you didn't increase by as much. So this could be a red flag, and something, even though you did still increase, you didn't increase by as much. Horizontal analysis will help you see that. So now let's look at an income statement that has the horizontal analysis computed on it.